Most traders spend their entire time in the market looking at exactly one thing: price. The candle goes up, they're happy. It goes down, they're stressed. But price is only half the story. The other half is something most people never bother to look at: volume. This isn't going to be a motivational video. There's no "you can do it too" speech coming. This is a practical, analytical breakdown of how institutional players, hedge funds, and serious traders actually read volume on Wall Street, and why retail traders tend to ignore it completely. We're going to cover 3 things today. First, the difference between price and volume, and why that difference matters. Second, a mental model called effort versus result. And third, 3 volume patterns you need to know how to spot: stopping volume, buying climax, and volume divergence. Each section comes with real examples and case studies, so this doesn't stay abstract. Part 1. Price versus volume. Let's start with a basic question. What is price? Price is just a number. It tells you the rate at which the last trade happened. That's it. Price alone doesn't tell you how much conviction was behind that move, how many participants were involved, or how much capital was actually driving it. That's the job volume does. Volume tells you how many shares, contracts, or units changed hands at a given price level. And when you read price and volume together, you start to see whether a move in the market is genuine or fake. Here's a simple example. Say, Apple, ticker AAPL, moves up 3% in a single session. If that move happens on volume that's well above the stock's average, say 2 or 3 times the normal daily volume, that tells you large institutional players, mutual funds, hedge funds, are participating in that move. That's a conviction move. But if the same 3% move happens on volume that's average or even below average, that tells you the move was likely driven by a handful of retail traders or thin liquidity. Moves like that usually don't hold. More often than not, price drifts back to where it started within a day or 2. Let's look at a real case study. During the meme stock rally of early 2021, GameStop, ticker GME, price moved in an extraordinary way. But what serious traders were watching wasn't just price, it was the volume pattern underneath it. In the early stages of the rally, volume kept climbing along with price, which showed fresh capital continuing to enter. But as price approached its peak, there was an unusual volume spike. Some sessions saw volume run 10 times the normal average. And yet price stopped making meaningful progress despite that surge in activity. That was a warning sign. It meant large holders were distributing their positions, selling into the demand, while retail buyers were still piling in. Within days, the stock collapsed. That gives us a core principle. Price tells you what happened. Volume tells you how it happened, and how much force was actually behind it. A trader who only watches price is trading on half the information. And in financial markets, half the information usually leads to the wrong decision. Let's look at this from another angle: support and resistance. Say the S&P 500, tracked through the SPY ETF, keeps stalling at a particular price level. If volume increases every time price approaches that level, it tells you there's real buying or selling interest concentrated there. That level actually matters. But if price approaches that same level on thin, dried-up volume, the level isn't nearly as significant as it looks on the chart. Volume is what validates a price level. Without it, a support or resistance line is just a line someone drew. Part 2. Effort versus result. Now let's get into the most important mental model in this video: effort versus result. This concept traces back to Richard Wyckoff, a trader and market theorist from the early 20th century, and his framework is still taught on institutional trading desks today. Effort is what volume represents: how much energy, How much capital, how much trading activity went into a move. Result is what price represents. How far that effort actually pushed price. In a healthy, sustainable market move, effort and result match each other. High volume produces a large price move. Low volume produces a small price move. But when the two start to diverge, when effort and result stop matching, that's where the real signal is hiding. Let's break this into 3 scenarios. The first is high effort, high result. This means heavy volume accompanied by a large price move. This is the healthiest scenario you'll see because it means a large number of participants with real capital behind them are agreeing on the same direction at the same time. A good example, when Nvidia, ticker NVDA, delivered stronger than expected earnings in 2023 on the back of AI-driven revenue guidance, the stock moved sharply higher on very heavy volume. Effort was high, result was high. That move was genuine, and it continued in the weeks that followed. The second scenario is high effort, low result. This is where volume is heavy, but price barely moves. This is the single most important warning sign that most retail traders overlook. It means a large amount of buying or selling is taking place, but price isn't responding the way it should. That almost always means a large player is standing on the other side of that activity, absorbing it. Picture a stock in an uptrend, where, on a given day, volume comes in extremely heavy, but the candle's body stays small and price closes back near where it opened. That tells you buyers are pushing, but an institutional seller is meeting that pressure with equal force. This pattern shows up often near the top of a trend, and it's known as effort without result, a classic sign that momentum is running out of gas. The third scenario is low effort, high result. Here, volume is light, but price moves fast. On the surface, this sounds appealing because price is moving quickly. But experienced traders treat this with suspicion because when price moves fast on thin participation, it means liquidity is low, and the move can reverse just as quickly as it formed. This shows up most often during low liquidity windows, pre-market sessions, or after-hours trading, where even small orders can push price around disproportionately. Here's a concrete case study. Throughout 2022, as the Federal Reserve was raising interest rates repeatedly, markets would often make a sharp move immediately after a Fed announcement, but on relatively light volume. Those moves frequently reversed completely within the next session or two because the initial reaction was driven by algorithmic trading and thin liquidity rather than genuine institutional conviction. Compare that to moves that happened around major jobs reports or CPI data releases, which came with heavy volume. Those moves tended to hold for longer. So the effort versus result framework gives you a way to judge whether a given price move deserves your trust. And that's the mental model that separates a beginner trader from an analytical one. Part 3. Key volume patterns. Now let's get into 3 specific patterns every serious trader needs to be able to recognize. Stopping volume. This pattern forms during a strong downtrend, when volume suddenly spikes, but the decline in price stalls or slows down. Picture a stock that's been falling for weeks, making a new low almost every session. Then, on one particular day, heavy selling pressure comes in, volume surges, price does make a new low intraday, but by the close, it recovers well off that low. That's stopping volume. It means a large institutional buyer stepped in and absorbed a significant amount of the selling, essentially buying up the supply that panicked retail sellers were dumping. A well-known example is the COVID crash in March 2020. As the S&P 500 kept falling, March 23rd, 2020 saw an extremely heavy selling volume day, and the market printed a new low. But the price action around that session showed selling being absorbed rather than accelerating. Despite the heavy volume, price didn't break down further. That session turned out to be very close to the actual market bottom. That wasn't a coincidence. Heavy volume being absorbed without price following through to new lows is often a signal that a downtrend is running out of sellers. It's important to note that stopping volume by itself isn't a buy signal. It's an indication that selling pressure is nearing exhaustion, and confirmation typically requires watching how price behaves over the following sessions. Buying climax. This pattern is the mirror image of stopping volume, but it forms at the end of an uptrend, when a stock has been climbing steadily for a long stretch, and then suddenly you see an extremely heavy volume session with a large gap up or a sharp move higher, but price fails to hold that high and starts drifting lower afterward. That's a buying climax. It means euphoria has taken over. Everyone wants in, and that's usually exactly when institutional holders are using that flood of retail demand to sell into strength and exit their positions. Take Tesla, ticker TSLA, as an example. In January 2021, as the stock approached its all-time high, several sessions showed extraordinarily heavy volume, multiples of the normal daily average. But following those high-volume sessions, price failed to make meaningful new highs for months and entered a long consolidation and correction phase instead. This pattern shows something important. When a stock is dominating headlines, when everyone is talking about it, and volume hits an extreme, that's often not a sign the trend is continuing. It's a sign the trend is exhausting itself. Volume divergence. This third pattern is more subtle, but it's extremely powerful. Volume divergence happens when price keeps making new highs or new lows, but the volume behind each move keeps shrinking. Say a stock makes a new high on 3 separate occasions. The first time, volume is heavy. The second time, when it makes an even higher high, volume is a bit lighter. The third time it makes yet another new high, volume has dropped off noticeably. That's a classic bearish divergence. Price is going up, but the underlying participation, the actual force behind the move, keeps declining. It means fewer and fewer market participants believe in that move, and the trend is running on fumes. A practical case study here comes from the tech sector rally of 2021 into 2022. Several growth-focused names, including ETFs like ARKK, kept printing new highs throughout 2021. But if you looked closely at volume during that stretch, participating volume kept declining with each new high. That divergence was an early warning that institutional interest was quietly fading, even while price continued climbing. A few months later, when the broader market corrected, those same names and ETFs saw some of the steepest declines because the genuine buying power behind them had already dried up well before the top. Volume divergence isn't only useful at tops, it shows up at bottoms too. When price keeps making new lows, but the selling volume behind each low keeps getting lighter, it means sellers are running out of conviction, even though price is still technically falling. This pattern often precedes a bullish reversal. Put these 3 patterns together, and a common thread emerges. Volume tends to show cracks and exhaustion before price does. Price is almost always a lagging confirmation, while volume behaves more like a leading indicator. That's exactly why professional trading desks, hedge funds, proprietary trading firms, institutional research teams treat volume analysis with the same weight as price action, and in many cases, with even more weight. So to recap what we covered today. First, price and volume tell you 2 different things, and reading them together is essential. Second, the effort versus result framework helps you judge whether a move is genuine or manufactured. Third, stopping volume, buying climax, and volume divergence are 3 patterns that reveal when a trend is losing strength, even when the price chart is telling a different story on the surface. This isn't a guaranteed formula, and this video isn't here to sell you some shortcut to getting rich fast. Volume analysis is a tool, a lens that lets you look at the market with more depth. The more consistently you observe volume alongside price, the more your understanding of the market shifts from reactive to analytical, grounded in evidence, not emotion. In the next video, we'll walk through these exact patterns step by step on live charts. Until then, pull up your charts and start paying attention to more than just price. Start watching volume.